The rollover day for futures contracts is one of the most misunderstood features in trading these contracts. Quite simply, rollover day is when traders start to exit the expiring contract and begin trading the front month contract that expires sometime in the future. Now, as part of your job as a trader, you must understand when the contracts expire and ensure that you sell or cover out of the existing contract before the date of expiration. The expiring contract can still be traded as it's still available up to the expiration day, but the liquidity will suffer, and you are best advised, if you want to continue in this position, to change to the new contract. Liquidity is the degree to which an asset or security can be bought or sold in the markets without affecting the asset's price. So this will avoid the problems associated with reducing trading volume, which I'll highlight later. Now, the word contract, when referring to the futures market, is an actual contract complete with obligations for both the buyer and the seller. The buyer agrees to take delivery if trading in commodities such as cattle, and the seller agrees to deliver the product. Trading in financials, the futures contract would be settled in cash. Now, the fact is that for the majority of traders, actual delivery never takes place, as they are just speculating on price and not actually buying the product itself. The instrument you are trading has a specific day that rollover occurs. All instruments are not created equal, though, as some expire quarterly, others expire monthly. Now, some of the most popular E-mini contracts are the ES, the Dow, the Russell, and they're known as stock index instruments. Now, these expire quarterly in the months of March, June, September, and December on the third Friday of the month at 9:30 Eastern Time. So note, each expiration month is represented by the following letters. March is H, June is M, September is U, and December is Z. So let's use the ES for an example, highlighting the March 2015 expiration, the ESH15. So the March 2015 contract expires on March 20th, 2015. The rollover to the June futures contract, the ESM15, is 8 days before expiry, which is March 12th, 2015. This is when you want to monitor the volume in your market as many traders begin to exit that current contract. Now, most traders that I speak with will either change contracts on the rollover or will trade the front month the next day. Now, another popular futures instrument to trade is crude oil, or CL. Now, instead of quarterly, crude oil rolls on a month-to-month interval. So keeping with March 2015, you'd be trading CLH15, but rolling over to the April contract, which is CLJ15, in the following manner. Number one, trading the current month, CLH15, will stop on the third business day prior to the 25th day of the month. Number two, if the 25th calendar day of the month is a non-business day, trading shall cease on the third business day prior to the last business day preceding the 25th calendar day. And I've offered this link up here for you can look for more information on that. So ensure that for any futures market you trade, that you are fully educated on the rollover particulars to avoid any issue with your trading positions. Now, you may have heard about difficulties with liquidity and increased volatility associated with rollover days. These result from the changeover that happens. Most traders move from trading the current contract into the next contract, and that means that the volume of the expiring contract becomes less, usually resulting in larger spreads, and the trading volume for the next period increases. Volume is just the total amount of futures contracts bought and sold during the trading day or any other time frame. So here we have a comparison of volume between the expiring month and the front month. You can see the gradual decline of volume plus the incline of volume in the front month. If you are not paying attention to rollover, you may start seeing its effects in terms of liquidity. The increasing spreads on the expiring contract can be harmful to you if you day trade, and the new contract will usually have very tight spreads on the rollover day. This is also important if you're a longer-term trader who wants to carry the contract past the expiration date, as the small spreads mean that you'll pay the least to do the transfer. If you are considering opening a position within a few days of rollover day, then you may find it better to use the new contract at the start. Futures contract rollover, it's not complex, but it's something you should be extremely aware of. While most markets roll over at the same time, as we've seen with crude oil, there can be differences. Now, just ensure that you are checking the calendar, and unless you're holding longer term positions, begin trading the front month contract when most of the other players change over.